Most people let their money sit in a savings account. But what if I told you that that same $10,000 could grow to nearly $2.3 million without lifting a finger? For years, Fidelity's top index funds have been quietly helping investors build significant wealth. These funds are affordable, well diversified, and designed to grow your money steadily over time, all while you let the power of compounding work its magic. In this video, we're exploring the 5 best Fidelity index funds that could put you on the path to financial freedom. We'll dive into real numbers, actual returns, and the potential these funds offer. No hype, no tricks, just straightforward insights. By the end, you'll see exactly how $10,000 could grow over 10, 20, or even 30 years. And let me tell you, the results might just blow your mind. Chapter 1. Why Fidelity Funds? Let's face it, investing can feel like a roller coaster. Stocks rise and fall, fees chip away at your returns, and one wrong move can set you back. But what if there was a simple, low-cost, and reliable way to grow your money? That's where Fidelity Index Funds come in. These funds are designed to track major stock market indices, giving you instant access to hundreds of top-performing companies without the need to pick individual stocks. And the best part? They're incredibly affordable. Some have expense ratios as low as 0.015%. To put that into perspective, if you invest $10,000, you're only paying about $1.50 a year in fees. But here's what really stands out. Over the long term, index funds have consistently outperformed most actively managed funds. Why? Because they don't rely on risky strategies like stock picking or market timing. Instead, they harness the power of compounding to grow your wealth steadily over time. With Fidelity's top index funds, your money isn't just sitting idle, it's actively working for you. Whether you're saving for retirement, aiming for financial freedom, or simply building wealth, these funds make it straightforward and stress-free. Now, let's take a closer look at the top 5 Fidelity index funds and see how a $10,000 investment could grow over the years. Chapter 2. Breakdown of the top 5 Fidelity index funds. Fund number 1. Fidelity 500 Index Fund, ticker FXAIX. If you want to invest in the biggest and strongest companies in the US, this is the fund to consider. FXAIX tracks the S&P 500, giving you exposure to 500 of the most dominant businesses in America. That means you're investing in Apple, Microsoft, Nvidia, and many more industry leaders. This fund is low cost, with an expense ratio of just 0.015%. That means for every $10,000 you invest, you pay only about $1.50 per year in fees. Historically, FXAIX has delivered an average annual return of 11.28%. That means if you invested $10,000 today, in 10 years, it could grow to $32,365. And after 30 years, it could be worth over $362,000. With steady growth, ultra-low fees, and top-tier companies, this fund is a must-have for long-term investors. Fund number 2. Fidelity Mid-Cap Index Fund, ticker FSMDX. If you're looking for companies with massive growth potential, but want more stability than small-cap stocks, FSMDX is a solid choice. It focuses on mid-sized companies, firms that are beyond their startup phase, but still have plenty of room to expand. This fund has a low expense ratio of 0.03% and a sector breakdown that includes technology, industrials, and financials. That mix gives it a balance of innovation and stability. Historically, FSMDX has returned 7.25% annually on average. That means a $10,000 investment today could be worth $26,250 in just 10 years, and $351,900 in 30 years. If you're looking for a long-term growth play beyond just the S&P 500, FSMDX brings a strong mix of performance and diversification. Fund number 3, Fidelity MSCI Consumer Discretionary Index, ticker FDIS. This fund focuses on consumer discretionary stocks, companies that thrive when people spend more on shopping, travel, and entertainment. Think Amazon, Tesla, and Home Depot, some of the biggest drivers of economic growth. FDIS has an expense ratio of just 0.08% and an average annual return of 13.23%. If you invested $10,000 today, it could grow to $36,450 in 10 years. And after 30 years, you could be looking at a balance of $459,000. This fund performs exceptionally well in strong economies, making it a great pick for long-term investors looking to benefit from consumer spending. Fund number 4, Fidelity Nasdaq Composite Index Fund, ticker ONEQ. If you want exposure to cutting-edge technology and high-growth companies, this fund is for you. ONEQ tracks the Nasdaq Composite Index, giving you access to giants like Apple, Nvidia, and Amazon. This fund is tech-heavy, with over 50% of its assets in technology stocks, and comes with an expense ratio of 0.21%. Historically, it has delivered an average annual return of 15.48%. That means a $10,000 investment today could grow to $43,959 in 10 years. And after 30 years, it could be worth $759,000. If you believe technology will continue to lead the market, ONEQ is a powerful way to capitalize on that growth. Fund number 5, Fidelity MSCI Information Technology Index, ticker FTEC. If ONEQ is tech-heavy, then FTEC is all in on tech. This fund focuses 100% on technology stocks, meaning you're investing in companies like Apple, Microsoft, and Nvidia, which make up 44% of the fund's total holdings. FTEC has an expense ratio of just 0.08%, one of the lowest in the industry for a sector-specific fund. And when it comes to performance, this fund shines. FTEC has an average annual return of 19.76%. That means a $10,000 investment today could grow to $62,400 in 10 years. And after 30 years, it could be worth an incredible $2.3 million. If you believe in the future of technology and innovation, FTEC might be one of the best growth funds available today. Chapter 3, Total Portfolio Projection. So, what happens if you don't just pick one fund, but instead spread your $10,000 investment evenly across all 5? That's $2,000 in each fund, covering the S&P 500, mid-cap stocks, consumer spending, tech, and innovation. Based on historical returns, here's what that investment could grow into. After 10 years, around $40,000 to $50,000. After 20 years, over $200,000. And after 30 years, potentially $790,000 or more. That's the power of diversification. You're not relying on one sector or one strategy. Instead, you're balancing stability and high growth. Some funds like FTEC and ONEQ are high risk, high reward. Others like FXAIX and FSMDX bring steady and reliable growth. By combining them, you create a portfolio that can handle market downturns while still capitalizing on massive gains over time. But investing isn't just about picking the right funds. It's about using smart strategies to maximize returns. Chapter 4, Key Investment Strategies. Investing in index funds is just one piece of the puzzle. The real secret to success lies in how you invest. Here's what you need to maximize your returns. First, start early and stay invested. Yes, the market has its ups and downs, but over time, it trends upwards. The longer you stay in, the more your money can grow. Second, reinvest your dividends. Instead of taking cash payouts, let those dividends buy more shares. Over decades, this simple move can add hundreds of thousands of dollars to your portfolio. Third, use dollar cost averaging. Instead of investing a lump sum all at once, contribute consistently, whether the market is up or down. This helps smooth out volatility and lowers your average cost per share. And finally, take advantage of tax-advantaged accounts like a Roth IRA or a 401k. These accounts can reduce taxes on your gains, allowing more of your money to stay invested and compound faster. Stick to these strategies, and that $10,000 investment could grow into something truly life-changing. Now, let's talk about the risks you need to keep in mind. Chapter 5. Risks. Let's be clear. No investment is completely risk-free, and that includes index funds. While they offer diversification and steady growth, there are a few important things to keep in mind. First of all, markets fluctuate. Even the best funds can have down years. The key is to stay invested and avoid the temptation to panic sell when things get rocky. Tech-heavy funds can be volatile. Funds like FTEC and ONEQ have huge growth potential, but they're also more likely to experience significant drops during market downturns. Lastly, and most importantly, past performance doesn't guarantee future results. While historical returns show strong growth, there's no way to predict exactly how these funds will perform in the years ahead. So, how do you reduce risk? Diversify your portfolio, stay consistent with your investments, and keep a long-term perspective. Now, let's bring it all together. Chapter 6. Conclusion. So, what's the bottom line? A $10,000 investment spread across the right Fidelity Index Fund has the potential to grow into hundreds of thousands or even millions over time. Now, the choice is yours. Will you let your money sit in a bank account earning next to nothing? Or will you put it to work and let compounding do the heavy lifting? Let me know in the comments. Which Fidelity fund interests you the most? And if you found this helpful, don't forget to like, subscribe, and hit the notification bell for more investing insights.